You checked your bank account this morning. Maybe you paid a bill, transferred some money, bought coffee with a card. Every one of those actions moved through a system you didn't design, didn't agree to, and can't opt out of. That system runs on debt. Not your debt, government debt. And that debt isn't a mistake or a crisis waiting to be solved. It's the foundation. It was engineered that way on purpose, over centuries, by people who understood exactly what they were building. In 1694, England was broke. Wars with France had drained the treasury. The government needed money it didn't have, and traditional lenders wouldn't loan anymore. A Scottish merchant named William Paterson walked into that crisis with a proposal that would reshape the world. He didn't offer England a loan. He offered them a system. Paterson proposed creating a private bank, the Bank of England, that would lend the government £1.2 million. But here's the part that mattered. The government would never pay back the principal, ever. Instead, they'd pay interest forever, funded by taxes. The debt would become permanent. Paterson wasn't solving England's financial problem. He was replacing it with a structure that made borrowing perpetual, interest guaranteed, and repayment unnecessary. Why would anyone agree to that? Because it worked. The government got the money it needed immediately. The bank got a guaranteed income stream backed by the power to tax an entire country. And the system stayed in place because both sides benefited. Debt wasn't temporary anymore. It was infrastructure. Before Paterson, governments borrowed money the old way. A king needed funds, borrowed from a wealthy family or merchant, and either repaid the loan or defaulted. Debt was a relationship between two parties. If the king refused to pay, the lender lost money, but the damage was contained. Paterson changed that. By making debt permanent and tying it to a central institution, he turned government borrowing into a financial instrument that could be bought, sold, and expanded. Debt stopped being a problem to solve and became a product to manage. That structure spread. Other countries watched England fund wars, build infrastructure, and expand its empire without ever repaying what it borrowed. They copied the model. By the 1700s, permanent government debt wasn't an experiment. It was standard practice across Europe, but the system had a vulnerability. Debt was still national. If one government collapsed, the damage stayed within its borders. That changed in the early 1800s with a man who understood that isolated debt was wasted potential. Nathan Rothschild didn't invent government bonds, but he turned them into a global market. During the Napoleonic Wars, European governments needed massive funding. Rothschild's banking network stretched across borders, allowing him to buy bonds in one country and sell them in another. He made sovereign debt liquid and interconnected. A bond issued by the British government could be owned by investors in France, Austria, or Prussia. Debt that had been confined to individual nations became a web. This had a critical effect. When debt is held by one creditor, default is an option. The lender loses, the borrower walks away. But when debt is held by hundreds of institutions across multiple countries, default becomes destabilization. If Britain refused to pay, it wouldn't just hurt one bank, it would trigger a cascade. Investors everywhere would panic, markets would freeze, credit would vanish. Rothschild's system made government debt too interconnected to fail. Countries couldn't default without collapsing the entire network. So they didn't. They kept borrowing and kept paying interest. And the debt kept growing because the system was designed to prevent any other outcome. By the late 1800s, the structure was embedded. Governments borrowed permanently. Debt was globally interconnected. But there was still a limit. Borrowing required lenders with money to lend. If banks ran out of capital or lost confidence, governments couldn't borrow more. That bottleneck disappeared in 1913 when the United States created the Federal Reserve. J.P. Morgan was central to that effort. He understood that a central bank wasn't just a lender of last resort. It was a mechanism to make government debt unlimited. Here's how it worked. The Federal Reserve could create money and use that money to buy government bonds. This meant the government's borrowing capacity was no longer tied to how much wealth existed in the economy. It was tied to how much money the central bank was willing to create. Debt stopped being constrained by savings. It became constrained only by a willingness to expand the money supply. Governments could borrow as much as they wanted, as long as the central bank kept buying bonds. And central banks kept buying because their existence depended on it. If they stopped, governments couldn't fund themselves. If governments couldn't fund themselves, economies would collapse. The system locked itself in place. By the mid-20th century, the structure was complete. Debt was permanent. Debt was interconnected globally. Debt was unlimited. But one question remained. What happens when countries borrow so much they can't even pay the interest? The answer came in the 1980s, and it wasn't default. It was something more insidious. Paul Volcker's policies as Federal Reserve Chairman triggered a global debt crisis. Interest rates spiked. Developing countries that had borrowed heavily couldn't service their debts. Mexico, Brazil, Argentina, dozens of nations faced insolvency. The system should have collapsed. Instead, it adapted. The International Monetary Fund stepped in, not to forgive debt, but to refinance it. Countries that couldn't pay were given new loans to cover old interest. The condition was that they restructure their economies, open their markets, and prioritize debt payments above everything else. The IMF didn't save countries, it saved the creditors. It ensured that even when debt became mathematically unpayable, payments continued. Default was replaced by perpetual refinancing. The debt never disappeared, it just got bigger. This was the final evolution. The system no longer needed countries to repay. It only needed them to keep servicing interest. And if they couldn't do that with their own money, they'd be loaned more to keep the cycle going. You're probably wondering how this connects to you. Let me make it explicit. Every dollar in your bank account exists because a government, corporation, or individual borrowed it into existence. When banks make loans, they create deposits. That's not a metaphor, that's accounting. Money is debt. And if that debt were repaid, the money supply would contract. Mortgages paid off, credit cards zeroed out, government bonds redeemed, and the dollars funding your paycheck would vanish. The system requires perpetual debt to function. It's not a side effect. It's the mechanism. This is why governments never balance budgets for long. Why central banks panic when lending slows. Why every crisis is met with more borrowing, not less. Reducing debt reduces the money supply. And reducing the money supply collapses the economy. So the debt grows. Always. You can't opt out of this. Your savings are denominated in debt-backed currency. Your paycheck comes from an economy built on credit. Your retirement depends on financial markets that function only when debt expands. Even if you personally borrow nothing, you're inside a system where everyone else must borrow, or the whole structure freezes. That's the trap. It's not visible because it's not presented as a trap. It's presented as normal, but the architecture ensures you can't escape. Every financial decision you make operates within rules written to perpetuate borrowing. Want to buy a house? You'll almost certainly need a mortgage. Want to start a business? You'll likely need credit. Want to invest? You'll buy assets whose value depends on continued credit expansion. And when things go wrong, when bubbles pop or markets crash, the solution is always the same. More debt, lower interest rates, quantitative easing, stimulus. The system doesn't allow contraction. It only allows more borrowing at a different rate. Now let's talk about the institutions that manage this. The International Monetary Fund, the World Bank, the Bank for International Settlements, central banks in every major economy. These aren't neutral administrators. They're enforcers of the debt system. When a country's debt becomes unsustainable, these institutions don't forgive it. They restructure it with conditions, austerity measures, privatization of public assets, policy changes that prioritize creditor interests. Argentina is a textbook case. Decades of debt crises, multiple defaults, repeated IMF interventions. Each time, the debt gets restructured, new loans issued, conditions imposed. The cycle repeats. Argentina's economy never escapes because the system isn't designed to let it escape. It's designed to extract payment. Greece offers another example. During the 2010 debt crisis, Greece owed money it couldn't repay. The European Union and IMF stepped in with bailout loans. But those loans didn't go to the Greek people. They went to creditors. French and German banks that held Greek bonds got paid. Greece got more debt and harsh austerity. Pensions slashed. Unemployment spiked. Public assets sold. The bailouts saved the creditors and trapped Greece in deeper obligation. This isn't failure. This is the system working as designed. But let's zoom out further. Who benefits from perpetual debt? Follow the interest payments. Governments borrow by issuing bonds. Those bonds are bought by banks, pension funds, insurance companies, sovereign wealth funds, and central banks. Interest flows from taxpayers to bondholders. In the United States, annual interest payments on the national debt now exceed $800 billion. That's more than the defense budget, more than Medicare. It's the third largest line item in the federal budget, and it only grows. Where does that $800 billion go? To whoever holds treasury bonds, domestic investors, foreign governments, financial institutions. It's a wealth transfer from the general population through taxation to the creditor class. And it's permanent. As long as the debt exists, the transfer continues. Scale this globally. Total world debt is over $300 trillion. Governments, corporations, households. The interest on that debt is trillions of dollars annually, flowing from borrowers to lenders, from the bottom to the top. This is the hidden mechanism of wealth concentration. Not through wages or profits alone, but through the structure of money itself. Debt creates money. Interest extracts wealth. The system is self-reinforcing. The more debt grows, the more interest flows. The more interest flows, the more wealth concentrates. The more wealth concentrates, the more power consolidates. And the more power consolidates, the harder it becomes to change the system. Because those who benefit from it control the institutions that govern it. Central banks are run by people from the banking industry. Financial regulators are staffed by former Wall Street executives. The International Monetary Fund is influenced by the largest creditor nations. The system regulates itself, and it regulates itself to continue. You might think voting changes this. It doesn't. Governments of every ideology, every party, every country follow the same debt model. Right-wing governments borrow. Left-wing governments borrow. Democracies borrow. Autocracies borrow. The system transcends politics because it's embedded in the financial infrastructure. Politicians don't control the money supply. Central banks do. And central banks are designed to be independent of elected governments. They answer to a mandate, price stability, and financial stability, both of which require continuous credit expansion. Stopping the debt means stopping the system, and stopping the system means collapse. So it never stops. Which brings us back to where we started. The system you cannot escape, not just governments. You, every purchase, every paycheck, every bill, every decision about where your money goes is shaped by a structure designed over 300 years to ensure debt never ends and interest always flows upward. Let's bring this into your daily life. You're not borrowing from central banks or issuing sovereign bonds, but the system still extracts from you constantly. Start with your mortgage. You borrow $300,000 to buy a house. Over 30 years at 4% interest, you'll pay $215,000 in interest alone. That's $215,000 transferred to the bank for the privilege of borrowing money that was created when you signed the loan. The house costs you $515,000 total. The bank gets $215,000 for doing nothing but holding the debt. Student loans work the same way. Borrow $50,000 for education. Pay $70,000 back over 20 years. The extra $20,000 is interest. It doesn't educate you. It doesn't build anything. It's extraction. Credit cards are worse. Average credit card debt in America is $6,000 per household. At 18% interest, if you pay the minimum, you'll spend decades paying it off and pay double the original amount. The system isn't designed for you to pay it off quickly. It's designed to keep you paying interest. Car loans, personal loans, payday loans. Every form of consumer debt follows the same structure. You borrow. You pay interest. The principal shrinks slowly while the creditor profits continuously. This isn't accidental. Consumer debt exploded after the 1970s when wages stagnated and household expenses rose. People couldn't afford life on income alone, so they borrowed. Credit cards became ubiquitous. Mortgage lending expanded. Student loans ballooned. Debt replaced wages as the way people accessed living standards. And just like government debt, consumer debt became permanent. The average American is never debt-free. Mortgage debt transitions to car debt transitions to credit card debt. One obligation replaces another. The debt remains. Who profits? The same institutions. Banks issue the loans. They collect the interest. They securitize the debt, bundle it, and sell it to investors. Pension funds, insurance companies, hedge funds, they all hold pieces of your debt and collect the income stream it generates. Your monthly payment on a mortgage doesn't just go to one bank. It's divided among dozens of institutional investors who bought securities backed by your loan. You're paying interest to a global network of creditors you'll never see or know. This is the same structure Nathan Rothschild created for sovereign bonds. Fragmented ownership. Global interconnection. Making default impossible because too many parties depend on continued payment. Now zoom out to the entire economy. Total US household debt is $17 trillion. Mortgages, student loans, credit cards, auto loans. The interest on that debt is hundreds of billions of dollars annually, flowing from households to financial institutions. Corporate debt is $11 trillion. Governments owe $36 trillion. Total debt in the US economy exceeds $70 trillion. Globally, over $300 trillion. Every dollar of that debt generates interest. And all of that interest flows upward to whoever holds the debt. This is the mechanism. Debt at the bottom, interest flowing to the top. Wealth, concentration through the structure of money itself. You might think you can escape by avoiding debt. You can't. Even if you personally hold no debt, you're still inside the system. You pay taxes. A portion of those taxes pays interest on government debt. You rent or buy. Either way, landlords and sellers factor their debt costs into prices. You buy goods. Companies pass their interest costs to consumers. You save money. Inflation erodes it, driven partly by debt expansion and monetary creation. There's no exit. The system is totalizing. But here's the question nobody asks. Why does it persist? If debt is unsustainable, if it concentrates wealth, if it traps populations, why hasn't it collapsed? Because it's not unsustainable within its own logic. The system isn't designed to be paid off. It's designed to continue. And as long as economic activity generates enough value to service the interest, it does continue. Think of it like a subscription you never cancel. It's not that you can't afford any single payment. It's that the payments never stop. Month after month, year after year. The subscription becomes part of your budget. You forget you're paying for it. It fades into the background. That's what systemic debt is. A subscription on the entire economy. Governments pay, corporations pay, households pay. The payments are built into the structure, and as long as payments keep flowing, the system sustains itself. Collapse only happens when payments stop, when debt can't be serviced, when defaults cascade, when the network breaks. But the system is designed to prevent that. Central banks inject liquidity during crises, governments bail out institutions, debt gets restructured, the payments resume. The 2008 financial crisis should have been a collapse. Trillions in bad debt, banks insolvent, the system teetering. But central banks created money, bought assets, backstopped losses. The debt was absorbed, not forgiven. The system continued. COVID should have triggered another collapse. Economic shutdown, massive unemployment, revenue collapse. Instead, governments borrowed $10 trillion globally. Central banks printed money. Debt expanded. The system continued. Every crisis proves the same point. The system will do anything to keep the debt alive. Because the debt is the system. So what happens next? More of the same. Debt grows. Interest payments grow. Wealth concentrates. The structure reinforces itself. Until it doesn't. Until the interest burden becomes so large that it consumes all economic output. Until confidence breaks. Until creditors refuse to lend. Until the whole structure, held together by belief and continuous payment, finally snaps. Nobody knows when. But the pattern is clear. Every debt system in history eventually reached its limit. Spain, Britain, Rome, Weimar Germany. They all believed they could manage it. They were all wrong. We're telling ourselves the same story now. That this time is different. That we can manage $300 trillion in global debt. That technology or growth or innovation will save us. Maybe we're right. Or maybe we're just the next chapter in a very old book. The system you woke up in this morning, the one you'll go to sleep in tonight, wasn't built by accident. William Paterson made debt permanent in 1694. Nathan Rothschild made it interconnected across borders. J.P. Morgan made it unlimited through central banking. Paul Volcker made default impossible through perpetual restructuring. 4 architects across 3 centuries, each solving an immediate problem while locking the next generation deeper into a structure they couldn't escape. You didn't choose this. Nobody asked if you wanted your money to be debt, your savings to be claims on future interest payments, your economic participation to require continuous borrowing somewhere in the chain. The choice was made before you were born, before your parents were born. The infrastructure was already built, already running, already embedded so deeply in every transaction that removing it would collapse everything. That's not a conspiracy. That's just architecture. Systems designed well enough don't need enforcement. They become the only option. And this system was designed very, very well. It sustains itself through every crisis, adapts to every challenge, and grows stronger with each intervention meant to contain it. The only question that matters now is whether you see it. Because once you do, every financial headline, every political promise, every economic policy reads differently. You stop asking why governments borrow more during crises. You understand they have no choice. You stop wondering why central banks always choose inflation over deflation. You realize deflation means debt collapse. You stop believing the next election will fix it. You recognize the system transcends politics entirely. 300 years of evolution created a machine that runs on debt and produces wealth concentration. You're inside it. Everyone you know is inside it, and it will keep running until the mathematics finally break or the belief that holds it together finally cracks. Until then, you make your payments. The interest flows upward, and the system continues exactly as designed.